For the fifth time this year, the Bank of Canada is expected to announce an interest rate hike today in an effort to combat inflation. Joining us with more this morning is financial commentator Pattie Lovett-Reid. Good to see you this morning, Pattie. Always a new location. I love this one.
I have to move around for the lighting. Okay, let's talk about the Bank of Canada, because you're absolutely right, Anne-Marie. It's largely expected 75 basis point increase, but we could see a full percentage point. The Bank of Canada wants to break the back of inflation. They want to drill it lower. But here's the challenge that they're faced with. As you know, rates continue to go higher, Canadians are indebted. And then, of course, you look at the economy. There's been basically over the last 3 months, no growth, not a lot of growth expected in the third quarter. Friday, we get the employment numbers, and on the back of 2 consecutive months of declines, even though there are about, call it 1 million job vacancies, we could still see another pullback. And so really, it's a difficult time for Canadians, but they've got to get inflation lower, which, by the way, stands at 7.6%.
So how will this hike, Pattie, compare to the previous ones that we've seen?
Well, you know, the last one was probably the largest hike that we've seen going back to, I believe it's August 1998. I looked at a report yesterday that came out from McEwen, and Canadians are financially fatigued. They are stressed. When you look at credit card use, basically from the first quarter to the second quarter, it's up about 6.4%. Non-mortgage debt for Canadians right now stands at over $21,000. This is the average Canadian. And Anne-Marie, that means Canadians owe $1.86 for every dollar of disposable income they have coming in.
Almost double.
So the average Canadian family, think about it. They have to come up with right now, just to deal with inflation, an extra $400 a month. That's a tough thing to do for a lot of families. And so you can cut back, scale back on big expenses, look at what you're spending money on at the grocery store. But Canadians are fatigued when it comes to their finances.
Pattie, there's a lot of Canadians this morning in a kitchen like where you are right now, having a cup of coffee or tea, thinking about everything that you're saying. How much debt am I carrying? Groceries are getting more expensive. What does this rate hike mean to Canadians who are carrying record amounts of debt?
It's a scary time. There's no question about it. And for some families, they continue to accumulate debt. I think you have to confront where you stand financially. There is no shame in reaching out. You may need some help. In some cases, you could get the interest clock stopped on debt that you owe. It doesn't mean you eliminate the debt, but you may want to reach out to your financial institution if you're having difficulty making a mortgage payment. The point is, this is not a time to stick your head in the sand. It's really important to be razor sharp on your numbers, but button down on your expenses. It's just not a time to be out there discretionary spending the money that you think you have when you haven't really looked at the numbers and you're not sure that you have.
I'm going to pick up on something you said, which is time. We learned this during the pandemic. People don't like indefinite timelines. So for anybody who's wondering, how long does it take for increased rates to start to impact inflation numbers, if that's indeed what these increases are for?
And that is exactly what they're for. You're absolutely right about that. The problem is we'd like to see it happen overnight, but it doesn't work its way through the system overnight that quickly. So I would argue that it probably takes about 18 months, which would suggest the second half of next year, you might expect to see a slowdown. We could hear from the Bank of Canada Governor Tiff Macklem, the interest rate announcements at 10 a.m. today, signaling that rates still need to go higher, but may even confront the reality that we could be headed towards a mild recession. That word alone scares people. But when you think about mild, I'm not talking big. You know, it could be a contraction of 0.1%, and that could be considered a recession, as opposed to growth of 0.1%. So let's put some context around it. But right now, you know, we're waiting to see how we can really get things down very quickly. Let's say inflation pulls back from 7.6 to 5%. It's a step in the right direction. But my bet is if that happens, the Bank of Canada has to have rates at 6%. And so think about it. We're at 2.5 right now. So variable rate mortgages, you might want to think about locking in. You may want to think about not using your credit cards quite as much. Just look at ways that you can pull back, and we'll get through this.
Yeah, I know sometimes, Pattie, people get scared of those numbers and they want to hide from them, but you make it seem palatable and powerful. So thank you for that.
Oh, thank you. Thanks.
Hey, thanks for watching. If you liked this, be sure to subscribe here, or you can check out more Your Morning videos right here.